On Business Connect today, we're discussing access to finance. At different stages of business growth, entrepreneurs require capital. At startup stage, at the middle stage, at the growth phase. Now, what kind of institution do you go to get different types of capital you need at different stages of your business growth? That's going to be our discussion today on Business Connect. And I'm not alone on set. I'm with my co-host, my friend, my buddy, Charles Odi. Charles, how are you doing?
Very well, very well. Thank you.
Now, we're talking money today on the show. We realize that there are different kinds of money to be borrowed. You don't just borrow from any borrowing organization at different stages of your business. At a particular stage, there's a kind of institution you should go to, and then it goes on and on like that. So We're going to be exploring that today on the edition of Business. And we have a special guest in the studio.
Someone who has been in the banking industry for quite some time now and been dealing with small businesses for over 10 years. And I think this is very key. This is very critical to small businesses, because when we talk to small businesses, half the time, the problem is money.
Yes.
Either how to get it, how to manage it, and how to grow their businesses with money. So this is just the right time to talk about
It's
money.
a timely topic. So we're going to be discussing that when we get back. Don't go anywhere.
There is a life full of unlimited possibilities. There is a solution to every situation you may be going through. Yes, your life can be beautiful. You can experience complete transformation in every area of your life. Love World Plus Response Center is here to show you how. Contact us through our various platforms for prayers, counseling, inquiry, and contributions. Call the numbers now showing on your screen. Send an email to info@loveworldplus.org or chat live with us at real time. Log on to www.loveworldplus.org. God bless you.
Welcome back. Today on the show, I have a very, very special guest. Charles, you do the honors of introducing him.
Right. Right. Today on Business Connect, we have someone who's been in the banking industry for 10 years. He is the CEO of Primera Credit. Primera Credit is a financial institution that span across microfinance banks and lending institutions. And today we have our esteemed guest, Mr. Cheta Agbo. Mr. Cheta, you're welcome to Business Connect.
Thank you.
Welcome to Business Connect. Now, first, let's just get into it. What kind of financing institution should I be speaking to at startup?
Yeah, at the startup phase, a lot of business people believe you should be talking to a bank. But those of us who have been in the SME space really don't advise young startups to talk to banks. We would rather you speak to family and friends, some rich dad, brothers or sisters, somebody who has funding or certain cash that can fund your business. But of course, as we move along, the financial sector has developed certain competencies in funding startups. So right now you're seeing angel investors or venture capital firms who specialize in funding startup businesses. So I would advise anybody who's a startup, who's looking to start a business, to first explore family and friends. And then, of course, if you have some institutionalization around yourself, you can now talk to venture capital companies or angel investors for your funding.
Okay, let's look at these different financial institutions. There's a microfinance bank, there's a commercial bank, the venture capitalists, you just mentioned angel investors. What is the difference in these institutions, and what kind of people are they looking for to lend?
Well, the fundamental difference between microfinance banks, deposit money banks, or what we call commercial banks, and either finance company or venture capital companies, as the case may be, we can look at it from various perspectives. It's really tied to, first, their target market, first, the scope, and the scope of their business. Now, for a microfinance bank has a certain, should I say, capital base. They are about in 3 categories. So you have a unit microfinance bank, you have state microfinance bank, you have national microfinance banks. Now their capital base is about 20 million, 100 million, and 2 billion. So these microfinance banks per se would focus, or they are, from a regulatory standpoint, are designed to focus on the active poor, or people who are or low income earners. So that of course automatically has limited the scope of what microfinance banks can do. Also from a regulatory standpoint, microfinance bank cannot engage in certain, should I say, mezzanine transactions. So international fund transfer transactions, yes, or international finance transactions, and mobilizing public sector deposits are things that microfinance banks cannot do. So that has limited, that has defined microfinance banks. Of course, you all know commercial banks and the things they can do, yes, and the things they cannot do. They are large institutions, have capital base of in excess of trillions and all that. And then for venture capital firms, they are really specialized financiers. Some take a bit of debt and equity, in your business. They unlike the traditional lenders, they need to have a long-term and an ownership mentality in their investments. And so that influences how they value businesses and how they evaluate the businesses they want to lend to. Or if I may call it, the financial decisions that they make. So these are, I would say, the differentiating factors,
okay,
of these various financial institutions.
You're the CEO of a microfinance bank.
Yes.
I want to find out from you, why do you advise that startup companies and SMEs don't approach commercial banks at startup stage?
Because startups shouldn't approach banks and microfinance banks in their startup stage. Because the type of funding that these financial institutions have is not the type of funding that the startup is looking for. A startup requires funds that can be burnt, if you know what I mean. If I throw in 2 million naira, yes, into a startup, I'm throwing in that 2 million naira with the full recognition that 2 million may not come back. Now, a microfinance bank and a deposit money bank can't make that kind of decision because their funding is essentially depositors out there.
Yeah, because you're using other people's money,
exactly.
Right?
Okay, because the risk portfolio is higher at startup.
Yeah, these institutions are regulated. Now, for private or for venture capital firms or private equity firms, that traditionally, lend or invest in startups, a lot of them, first of all, a lot of private equity and venture capital firms are specialized. So some of them are focused on the retail sector, some are focused on it. So they understand the businesses they are going into. And they know, because they understand how to value those businesses and they know the risk they are taking. For a banker, that kind of risk is not the type of risk I would expect my banker. I mean, let's take for instance, I lend 2 million to an organization. I don't like to tell my depositors when they come to withdraw their funds, I gave the money to Charles, yes, and Charles can't give me back. Charles hasn't paid, and therefore you need to come tomorrow. Once that news gets out there, everybody floods my bank and wants to withdraw their funding because they can't trust me, with their money. And people need to understand that that's just the fact.
Okay, now let's look at an existing business trying to approach a financial institution because they need capital probably to scale. What are some of the things that you would look out for in making a lending decision?
Well, clearly, any financial institution in making a lending decision would always first look at who am I lending to. So I look at you as the promoter. Do I know you? Do you have a track record? Do you understand this business? And after I've done that level of evaluation, I'll probably look at how much have you invested in this business? How much do you understand this business? Then I'll now start looking at the business proper to look at the cash flow that this business generates. I'll look at, okay, do you have some collateral? just in case things go wrong. And all other things I'll be looking out for. But if we just cut it down square to just 2 things, I'll look at you, I'll look at your competence, and I'll look at the cash flow potentials of that business. These are the 3 things I'll probably look at.
So you're going to look at how much money they've been making, and that's why it's important for SME owners to bank their monies, right? Or to keep a record of what comes in, what goes out, so you can show an institution that, hey, this is what has been happening. And with that, they can make a decision on you.
You see, it's the interesting thing about small and medium enterprises. We bankers will call it asymmetric risk.
Yeah.
And the risk that arises because there is some level of opacity. We don't have sufficient information which we use to evaluate you as a business. So, and it's a traditional problem with, evaluating micro, small, and medium enterprises. A lot of them don't keep enough records. A lot of them don't engage in certain practices that reduce their risk. So, even down to ethical practices, because ethical practices translate into either market or operational risk that can destroy the entire enterprise. So, and these are of concern to either bankers or investors who would like to invest in these organizations. Yeah, so those are the factors.
All right. Now, let's look at approaching a microfinance bank for money. A lot of people say microfinance bank, they lend very little and they give you a very short time to pay back. Is this the case, and why is this the case? You're coming to ask for some money to run a business, and yet sometimes you don't get enough time to pay back. I want to talk from the perspective of a microfinance bank now. Since you're CEO of a microfinance bank, let them understand why it's the case.
First, they need to understand why microfinance was formed.
Okay.
The public out there needs to understand the role of the microfinance institution. In the overall financial sector, there are tiers or segments. The international banks are playing in a particular niche, probably funding global organizations. Certain local or regional banks are funding regional corporations or local corporations of a certain size.
Yes.
Microfinance banks were formed primarily to address the challenge of access to finance. There are businesses and individuals out there who would not walk into the banking hall to do business with a proper commercial bank. The processes, the manner in which commercial banks appraise investments exclude the masses out there.
Exactly.
So these institutions, microfinance institutions, were created for that purpose, to include the masses into the financial system. And in environments like Nigeria, with a 160 million or 170 million population, there are lots of people that are excluded from the financial system. And microfinance banks were created for that purpose. And if we go back into the history of microfinance and their modus operandi, now in terms of methodology, now these, if I may call it active poor, people who are engaged in some of economic activity, but they're really poor people in terms of global benchmark for assessing poverty. These people typically wouldn't have collateral because a bank traditionally would ask for collateral.
Yes.
So they're not asset rich. So you need to create a methodology to fund these businesses. These individuals, the kind of funds they're asking for is not that much.
Yes.
It's about $2,000 or $1,000, even less than $1,000.
Exactly.
So the funds are not much. And then because of the risk profile and the cost of serving them, which technology has largely mitigated, you need to create a structure that fits the cash flow pattern of the people in that space. So if we look at the nature of businesses people in that space do, we see that they are high cash generating enterprises. So we tailor, the services we offer them to suit the cash flow pattern of their business. So they're usually short term because of the risk, once again.
Yes.
So the funding we give, usually short term, small. So if you see yourself looking for funding above what a microfinance can offer you, then clearly your needs have exceeded the microfinance
Okay,
space.
I'll just cut in because we're going to go on a break right now. When we come back, we're going to wrap up that thought and we move on to some other questions about how businesses can raise the financing they need to run. We'll be right back.
Level Plus is now on your mobile format and connects you in real time. You can now watch your favorite programs, episodes, live shows, prayer shows, features, live TV, archived videos, and lots more. You can also participate with your comments and contributions from anywhere in the world. Download on any of your mobile device, whether it's Android or iOS or Windows, the Level Plus mobile app now and stay connected. Level Plus, totally you.
All right, welcome back. If you just joined us, this is still Business Connect, and we're talking to the CEO of Primera Credit, Mr. Cheta Agbo. And before we went on the break, Mr. Cheta, we were talking about access to finance and the level of financing. So you made a point about people who want money bigger than what a microfinance bank can offer. So those people in those categories, where do they go to beyond the microfinance bank?
Organizations that require funding beyond microfinance have to start building relationships with deposit money banks and venture capital or private equity organizations to fund their businesses. Clearly, their financial needs have gone beyond beyond which microfinance banks can now afford or can fund. So it just makes sense. They have, and for a microfinance institution, for instance, my organization, if you come to me and you're asking for funds, very large amount of fund, I know that within my organization, the competencies of my staff, can no longer address your needs. So if you, as a microfinance organization, see yourself in that kind of position and you start making such decisions, then you're putting your organization at risk. You're endangering the sustained life of your organization. And that is a bad decision to make.
Okay, I want to ask you, now, what's the amount you peg as a loan to give out to these SMEs for a microfinance bank?
Well, in the microfinance, it depends. Various organizations have their own benchmarks, and your benchmark would probably have to do with your share capital, So I'm sure that's quite clearly beyond the scope of this interview. However, the nearest answer I can give is to give you the definition of a micro, small, or medium enterprise. And there are two definitions. One, the global definition is that of using the size of employees. While there's another definition, of course, there are certain organizations that cannot fit, that a number of employees in their organizations wouldn't fit. So we use the total assets, or their sales turnover to assess them. So for micro enterprise, if you have about less than 10 staff in the organization, you're deemed to be a micro enterprise. If you have from 11 to about 50 staff or employees in your organization, you're deemed to be a small enterprise. And if you have above 50 to 200 staff in your organization, you're deemed to be a medium-sized organization. And looking at value, now either in terms of assets or in terms of sales, micro enterprises are deemed to have assets or sales turnover of 5 million.
5 million naira.
Yes, 5 million naira. Small organizations are deemed to have 50 million in turnover or assets, while organizations above 50 million to about 500 million in assets or turnover are deemed to be medium-sized organizations. But let's also understand these definitions are actually based on the national policy, SME policy of Nigeria. Now, various organizations have their own benchmarks. So, for instance, the IFC has its own benchmark. The IFC looks at any organizations whose turnover is below 100,000 as a micro enterprise, $100,000. You know, while an organization that is whose turnover is about $3 million are small, and $50 million as medium. So, you know, there are multiple benchmarks.
Okay, now let's look at venture capital funds. Venture capitalists are more willing to lend to startups because they're willing to risk those funds even more willingly than microfinance banks and commercial banks. Now tell us, what are the advantages and disadvantages of lending or borrowing money, in this case, from a venture capitalist?
Yeah, the disadvantages also basically have to do with the model, how venture capital companies lend to startups. Essentially, they package their funding to be part equity and part debt. Now, it is that equity portion that they take in your business that, if I may use the word, now create the disadvantages. For me, the disadvantages really boil down to that loss of control. So if you're going to take up equity if a venture capital firm is going to take up equity, you know, in your business or is going to invest in your business, you must accept that you're going to lose a certain degree of control over that enterprise. You would have to subscribe to certain ethical practices. You are bringing an investor who is going to partake in the operations on how you run your businesses, even down to how you hire your staff. So that control you have lost is, for me, a major disadvantage. And that is something a lot of promoters of businesses may not be willing to deal with. You know, so from a psychological standpoint, you need to overcome that before you can actually, you know, be willing to embrace a venture capital company.
Yes, because sometimes we hear that the ideology of the venture capitalist may differ from the ideology of the startup or the entrepreneur who started it. So he wants to go this way, but the man with the money wants to go this way. So if you're ready to
exactly, you know, so that's why I said that, you know, the venture capital firm would get involved in the operations of the enterprise. Because, you know, with every business, what you find out is that you start a business in one direction, you wrote your wonderful business plan, then you get into the business. You start facing the vagaries of the marketplace.
Exactly.
And then along the line, you see that the direction you started may not be the way to go. And then you have to change direction. You know, sometimes the venture capital companies bring in a wealth of exposure from international markets to bear. And, you know, they're able to give you some direction or some practices that it may be best you uphold. And of course, so this level of, if I may use the word, interference, you know, may not suit the temperament of the entrepreneur. You know, so you need to have that level of maturity and accept that these are areas that you will have to cede control, you know, for you to be willing or for you to be ready to accept venture capital funding.
Is there a risk of the venture capitalists taking over the ownership of the business of an SME?
There is a risk. There will always be that risk. The moment you bring in investors into your business, that's why I said you have ceded a certain level of control. The more there's a business downturn, the more you lose control. You understand? Yes. The more, you know, the more the capital requirement of the business. But for instance, you start a business with 20 million, and that's all the money you have. Now, the business grows, is profitable, but needs to jump to a certain level of growth. You need to pump in more money.
Yes.
The venture capital asks you, where's your own? You know, because they have theirs. You know, so it's about that mindset of being willing to cede control. If you don't have that mindset, then you're not going to be able to work together with a venture capital company.
I mean, one of our clients approached us, and she said that she started a business with $60, and she's been able to grow her business to $60,000 with equity-free fund. Is there anything like equity-free fund?
I don't know what she means by equity-free fund, because the money, the funds she put into her business is equity.
Yeah.
So I don't know what she means by equity-free fund. All I can say that statement means is that she didn't bring in additional investors into her business. That's what I would interpret that statement.
And she still has 100% ownership.
Exactly. So what that statement means is she owns 100% of the business. That is what I would interpret.
I think she got grants. I think that's just it.
Wonderful. If you get grants, wonderful. You still keep 100% of your company, but you have still ceded control, because the people or the organizations who give you grants would demand certain level of transparency and accountability.
Yes.
That's a certain loss of control. They would demand certain ethical practices, and that means you have to tweak your operations to meet with those ethical practices. So either way, you see there's some certain level of control. So.
Now, one of the things that entrepreneurs complain about is the high interest rates. Now, of course, we need policy to be able to bring down the interest rates, but we were talking before we came on set that the challenge is not really the level of the interest rate, but something else. What should an entrepreneur be concerned about really when it comes to lending money and repayment?
Yeah, and this is purely these are purely my thoughts in this matter. People are free to, have a different view. I believe very strongly that a successful business is not bothered about interest rates. Yes, interest rates is something that is not under any businessman's control. There are so many factors that determine the interest rates. Every country has a central bank. No businessman can tell me he's in control of his country's central bank or is in control of all the central banks in the world. So since clearly, interest rates are not within your control, the businessman just has to focus on areas that are within his control. Now, the returns you make in your business to somewhat are really somehow within your control. Yeah. They are within your control in terms of the revenues you're able to generate. They're also within your control in terms of the cost, your cost of doing business. Yes, in this market, it may be cost of doing business may be high, but the truth remains is that you have some level of control. You choose where you spend your money.
Yes.
Now, so if your returns are actually higher than the interest rates, then you can actually borrow in any market that you're in.
True.
And
True.
pay back and continue running your business.
Okay.
So to this degree, a successful business is not bothered about interest rates.
Really. So much to say on today's edition of Business Connect. We've talked about keeping the books so that when you go to financing institutions, they can say, oh, I can see your inflow, I can see your outflow, I can see the cycles of your income, and say, okay, yes, I want to make a decision for your business and lend you money. We've also talked about the different levels. As you grow, you need to know whether you need to be talking to a venture capitalist, a microfinance bank, a commercial bank at all. And then, of course, we also finally explored how that no matter how high the interest rates get, we understand that interest rates could go as high as they want to, because nobody really is in charge of that. You need policy to change that. But if you can ensure that your business is more profitable, you won't be scared of interest rates at any time. Charles? Nice thoughts on Business Connect today, right?
Very nice, very nice.
Yeah, Cheta, I want to thank you so much for coming on the show to share with us some of the things that you do as a professional banker and the CEO of Premier Credit. I want to thank you so much. We're looking forward to the viewer reaction of everything you said. I'm sure they must have learned so much. So you check out the community yourself and see what they're saying about it. I'll give out the address right at the end of the show. Now remember, you can watch this broadcast and previous broadcasts of Business Connect on www.lovoplus.org, as well as on our dedicated website, which is www.businessconnectonline.com. To interact with us via social media, you could go to our community on Yokos. Yokos is YOOKOS.com, yokos.com, and the community address is www.yukos.com/groups/businessconnect. You can see these addresses scrolling on your screen right now. Thank you very much for tuning in this week. Till we meet again next week, keep winning.